Every investor begins their journey with curiosity. How do companies raise money? How can I, as an individual, participate in that process? If you have ever wondered what shares really are, how IPOs work, or what is the difference between primary and secondary markets, this is where your understanding begins. In this video, we are going to demystify the securities market and explain how you can invest both at the time when shares are first issued and later on when they are traded. Let's begin with financial instruments, which are the building blocks of the securities market. First up, we have equity shares, which represent ownership in a company. When you buy them, you become a shareholder, which entitles you to dividends and voting rights. Second, we have debt securities, which are issued when a company borrows money from investors. These are typically known as bonds or debentures. Investors earn interest over time and are repaid the principal amount at maturity. Debt securities can either be secured or unsecured. Then we have derivatives, which are contracts whose value is based on the price of an underlying asset like stocks, commodities, or bonds. The most common types are futures and options. Well, we also have mutual funds, which are investment vehicles that pools money from multiple investors and invest in a diversified portfolio managed by professionals. This allows small investors to access a broad range of securities without having to manage each one individually. The securities market is a platform where companies raise capital and investors buy and sell financial instruments. It plays a crucial role in the economy by moving capital from those who have it, that is individuals and institutions, to those who need it, that is companies and governments. In return, investors receive returns in the form of interest, dividends, or capital gains. This market is divided into two interlinked segments. First up, we have the primary markets, and second, we have the secondary markets. The primary market is where companies issue new securities to raise capital directly from investors. The most common method is through a public issue or an initial public offer, widely known as IPO. In a fresh issue of shares, the company creates new shares and offers them to the public. The money raised goes to the company. In an offer for sale, existing shareholders sell their shares to the public. The proceeds go on to them and not to the company. Other issue types include follow-on public offers, rights issues for existing shareholders, bonus issues with free additional shares, and private placements made to select investors. Before making an issue, the company files a draft red herring prospectus with SEBI. The document outlines company details, financial risks, the purpose of raising funds, and more so that investors can make informed decisions. When a company comes out with a public issue, you can apply for the shares by filling out the application form during the offer period. In the form, you provide personal details, the number of shares you wish to apply for, your bank account information, and your Demat account number. This Demat account number is where your allotted shares will be credited. The company must follow SEBI regulations for the issue. Shares are allotted as per these rules and are credited in dematerialized form. After the issue is closed, shares are allotted and listed on recognized stock exchanges within 6 working days. Once listed, the shares become available for trading in the secondary market. How to apply for an IPO? To apply for an IPO, investors generally use two methods. First up, we have ASBA, and next we have normal UPI method. ASBA stands for Application Supported by Blocked Amount. It allows the amount required for the application to be blocked in your bank account. It is only debited if the shares are allotted. If not, the funds remain untouched and are released automatically. The UPI method is quicker and more mobile friendly. In case of the UPI method, you approve the transaction through a UPI app, the funds are blocked in the same manner. Whether you use ASBA or UPI, the process is seamless. Shares once allotted are credited to your Demat account and the payment is deducted accordingly. Once the shares are listed after the IPO, they can be bought and sold in the secondary market. To start trading, you need to open a trading account and a demat account with a registered stockbroker affiliated with a recognized stock exchange. After opening your account, you can place buy or sell orders through various channels, using the broker's website, their mobile trading app, over a phone call through the call and trade facility, or by visiting the broker's office in person, or through authorized persons who represent the broker in different locations. Trades are executed on platforms like NSE or BSE, and once the trade is completed, shares and funds are settled digitally through your demat account, which is linked to your bank account. The securities market is one of the efficient ways to connect businesses with investors. It offers structured opportunities for companies to raise capital and for individuals to build wealth. Now that you understand how both the primary and the secondary markets work, you are equipped to take your first step into the world of investing. If you found this video helpful, consider subscribing for more such content. Drop a comment if you want us to cover more such topics. Thank you for watching. See you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.